But they that wait on the Lord shall renew their strength. They shall mount up with wings as eagles. They shall run and not be weary, and they shall walk and not faint. Isaiah 40:31.
In this video, I'm going to talk about the actual steps to get you in the stock market investing. It is as easy as 1, 2, 3. So I'm going to talk about choosing a brokerage firm, what they look for when you go on that site to open the account. We're going to talk about you defining your why and also some other things surrounding investing that you should look at as well. And I'll also talk about some things you can consider investing in if you are a beginner. Hi, my name is Valerie. Welcome back to my channel. And if you're new here, I'm glad you found me. So number one, the first thing you want to do is select a brokerage firm. A brokerage firm is a firm that or where you can buy and sell stocks, bonds, ETFs, index funds, or mutual funds. Now, that brokerage firm, we want to select a brokerage firm that allows you to purchase fractional shares. Fractional shares are pieces of a company. For example, if a stock of a company costs $300, you can buy a part of that company for $5 or whatever your budget will allow. So these firms, Fidelity, Webull, Robinhood, Schwab, they all offer fractional shares. Vanguard also offers fractional shares, but I believe it's just on their Vanguard products, their Vanguard ETFs. So you want to do your own research. Pick a brokerage firm that speaks to you. So you want to go to Google, pull up a brokerage firm, pull it up on your phone, because you'll find that you'll do a lot of this on the phone using the phone app. You'll have to download it, of course, from the App Store. So choose a brokerage firm whose interface is easy for you to understand and for you to navigate. When you go to set up your account, they're going to ask you for your personal information. They are going to ask you for your social security number and also for your bank account. They're going to want you to link your bank account, and you need to do that. You need to give them your social security number because that will allow them to report your earnings to the IRS. And you need to give them your bank account information. It needs to be linked so we can have funds. You can have funds going in and out of that account. Now, we in this group, I believe we're the over 50, over 60. We're the Gen Xers, right? And baby boomers over here. So we're probably looking at long-term investing. And so that brings me to a point before I go even further. If you have not already looked at the video that is asking you if you're a new investor and you're still unsure, right? You need to go back and look at that video. You need to look at that video because it talks about compound interest. That is key to long-term investing. That is the whole benefit, and that's the driver in long-term investing, along with consistency, of course. And while we're here, I'm asking you to look at the video all the way through, guys. When you view a video, that is awesome. But guess what? When you like a video, that's like a wink to the algorithm. When you comment, that's another wink to the algorithm, right? When you share, subscribe, those are all speaking to the algorithm. It's saying, this is a good video. We want this video to go out. We want other people to see this. Other people need to know this information. So I'm asking you to like, comment, certainly comment, share, and subscribe. So they're going to ask you for that personal information. Put that information in there. Yes, link the account. Link the account, and you'll be ready to go. So after that, you're going to want to decide what type of account you want. You can have just a plain brokerage account, but over here, we are probably looking at long-term or retirement accounts. A plain brokerage account is fine. It's for investing. But a Roth, R-O-T-H, IRA account, that is very attractive in the investment world, because the money that you contribute to a Roth IRA is after-tax dollars. But the beautiful part about it is that your earnings, the growth, the interest throughout the years, when you get ready to withdraw it, it is also tax-free. So that is the benefit of maxing out an IRA. A couple things that you need to know about an IRA. You can only have one active IRA. That's the first thing. Number two, you do want to do your own research so that you can corroborate what I'm saying. Now, there are also income contribution limits. So if you're under 50, you can contribute $7,000 a year. If you are over 50, we get to contribute an extra $1,000 a year. So that would be $8,000 that we can contribute to our Roth IRA. And you want to contribute that after-tax money and as soon as you can, and let that money start growing and compounding. Now, it does not grow and compound just because it's in a Roth. The Roth is like the shell, it's holding it. But when you put it in the Roth, then you have to select a security that you're going to invest in. That's going to be that ETF or that index fund. And that's the only thing that I'm going to be talking about here, because I'm mostly talking to over 50, over 60 investors and beginning investors. And not only that, I guess that covers everybody actually, because if you're a beginning investor, no matter what your age is, you want to start with something that is considered to be safe, relatively low risk, and diversified. And that is exactly what ETFs are. So generally, many people like to use the total stock market as their basis or foundation for their portfolio. So I have in another video, I talked about the money, my side hustle money being invested, and I exposed that ETF, and it was VTI. So VTI holds the total stock market, and another is VTSAX. So those are, well, VTSAX is an index fund. It trades a little bit differently. And then VTI is an ETF. But we're not really concerned about it trading at all. We're buying and holding. We're buying and holding. We're holding for decades until our particular goal is met. And so the ETFs, and then if you want to just cover the S&P 500, those are the 500 largest companies in the United States. Those are other ETFs. One is called VOO, very, very popular ETF, and the other is FXAIX. I'll put it here. But you don't have to take my word for it, guys. You literally can Google ETFs that track the total stock market. And then you can also Google ETFs that track the S&P 500. And it will bring you up different ETFs. And then you can compare them with their expense ratio. But the ones that I listed are low, have low expense ratios. Okay, so that's what you're going to do. You're going to decide what instrument what security that you want to invest in. We're talking about deciding on a firm, deciding on the instrument you're going to invest in. But guys, even before you do that, you need to define your why. You need to know why you're doing what you're doing, because that's going to help you with the decisions as you go. So is this for to cushion your retirement, to supplement some income? Long term, are we talking about a decade? Are we talking about 2 decades? Are we talking about 15 years? Or is this a short-term investment? Some of you may not be in investing or interested in the decades-long investment because you're trying to buy a house and you want a down payment. So just knowing your why you're doing what you're doing, that's going to help guide your decisions along the way. The other thing that you really need to think about, guys, is we're talking about investing, and I know I'm talking to the over 50s, over 60s group, and but still, even in our group, guess what? We have to look at the whole financial picture, the whole pie, because if you have credit card debt, if you don't have an emergency fund, those are some things you need to look at too. So I know that I'm talking about investing in the stock market, but what can happen is that you can invest in the stock market and your portfolio is growing beautifully. And then if you have an emergency, but you didn't set up an emergency fund, now you're thinking, I've got that $45,000 sitting in my brokerage firm. I'm going to go and get that money from there because I got it. That is not what I am talking about. What I am talking about is long-term investing. This is not investing that you pinch out of because you hit a crisis. You have to deal with your crises with your day job or with your side hustle. But this what I'm talking about is long-term. Don't touch it. This is decades. This is how this is going to sit. So we can let the compound interest do what it does, right? So I mentioned that so you can start thinking about that. So because everything that I'm saying, if you corroborate it by just Googling it yourself, that gives you more comfort and more confidence to take the next steps. So that's what I want you to do, is whatever I say, look it up and find out. You want to decide your strategy. Now, the strategy for long-term investing, if you're going to do this seriously, the strategy is dollar cost averaging. It's called DCA, dollar cost averaging. Dollar cost averaging is when you put in a set amount of money at regular intervals, whether the market goes up or down. You're still buying that security no matter what the market is doing, right? And overall, what it does is it reduces the market volatility within that ETF, and you wind up getting the best price for that security. So dollar cost averaging, and you can do this also in the brokerages. You set your deposits up for recurring investments. You're going to tell it which security you want. You're going to tell it how much you want to invest in every week, every 2 weeks, or every month. And you're going to set it on the same day, and you're going to leave it alone. And that is what's called dollar cost averaging. And you want to do it automatically so that you don't have to remember to buy that stock today. Just set it up on automatic, make it easy for yourself, and know that you've chosen an excellent security to invest money in, and that it is going to pay off in the future for the future you.